Welcome to this week's Market Matters video update. It's the 17th of November. It's Wednesday today. Jimmy in separate offices for the moment. We're going to talk about markets. We're going to talk about CBA and a couple of stocks we like to own in the video. Kicking things off with markets. They've been choppy, they've been up, they've been down, but sort of hanging on to this 7,400 level without too much direction. James, what do you make of that?
Yeah, you're not wrong, Harry. It's been a huge amount of sort of sector rotation. One sector does well one day and then gives back all the gains the next day. And that on the index level, it's just meant that the market's been very subdued. We've written about this 74.80 level on the S&P ASX 200 for the last few weeks. It feels every time it hits that level, it's sort of like a brick wall, if you like. There hasn't been the impetus to push it through. So, right now the market actually looks okay. Consolidation is fine. It's eating up, given the backdrop of sort of the news flow that we've seen. So you think about the backdrop about rising interest rates, what we've seen from central banks, what we've seen from bond markets, etc. So the resilience of the market here is really encouraging, and I think we ultimately will break out of this resistance zone at the moment and chase what's been playing out in overseas markets. The US market's been making all-time highs again. So I'm still bullish on the market, Harry. I think we'll break this resistance level and push on into a Christmas rally. So no change from our rhetoric over the last few weeks.
One thing holding back the market today is CBA. It's down 6%. I think I did the numbers today. The last time it was down 6% in a day was the 1st of May last year. Just a long time ago. Their first quarter update, it's actually taken 32 points or 36 points off the market. The market's only down 22 today, so go figure. Probably why that one's choppy today. But is the result as bad as the market's giving it?
Yeah, so they came out with a first quarter trading update today, and I guess the high notes were that cash earnings for the quarter came in at 2.2 billion. This is unaudited, and the other thing they flagged was a weakness in net interest margin. So that weakness in net interest margin is one component to it, and all the banks are experiencing it. With low rates, it's hard to alleviate that margin pressure. So I think the dynamics of interest rates going forward is going to be a positive for margins. Just in terms of the cash earnings, if you annualize the 2.2 billion for the full year, so what they've done for the quarter, and annualize it for the year, you get 8.8 billion in cash earnings. The market was at 9.12 billion. So it is a miss in terms of market expectations. I'd call it about a 5% miss, Harry. So the stock is trading down 7%. The other thing that's important here in terms of CBA is the premium that it was trading at relative to the sector. So CBA generally trades at a pretty decent premium to the sector, but it's been, leading into this update, it's been as big a premium as we've seen. It was priced for perfection, if you like. We wrote about it in the last couple of weeks. We had a discussion about it we had a discussion about cutting it from portfolios given valuation. We didn't. We have trimmed it into strength, but I wouldn't get too concerned about it. So no, in short, the result wasn't that bad. There's just the run hard into the result, and people expect a lot from CBA, and they didn't quite get a lot. It's about a 5% miss on my view.
Yeah, we actually spoke to Westpac's CFO Michael this morning, and he sort of reiterated those comments about NIM pressure. Those fixed rate loans are putting all the banks under a bit of NIM pressure at the moment. And that will cycle out as these banks have started to lift those fixed rate loan prices. So maybe we see that wash out through the rest of the year, James.
Yeah, that's a really good point, Harry. I think we've had Westpac in, we've had NAB in over the last couple of weeks. So what they're talking to is, good momentum in the business. So there's good momentum in sort of loan growth, good economic momentum in the Australian economy, but they're just dealing with this margin pressure at the moment. So, that will iron itself out. So I don't think it's any reason to change our positive rhetoric on the banks. We don't have a big overweight position in the banks like we had a couple of months ago. We're happy with our positioning at the moment. Obviously, we would be more happy if CBA wasn't down 7% today, but we remain, we remain positive on the banks going into the back end of the year. And this dynamic around rising interest rates will be really important for that margin expansion to take place.
Looking out into 2022, if this market does sort of turn higher, what are sort of three names that you'd love to be holding into Christmas and probably beyond as well, James?
Oh, that's it. It's an interesting question. So it's about buying something, right here, right now. What would three stocks I'd be happy to go out there and buy? I'll give you a large cap idea, just in terms of the macro backdrop we've been speaking of, rising rates, inflationary pressures that are building. I think you've got to be really conscious of that. So QBE Insurance is one that we've got in the flagship growth portfolio. We've bought it around these levels. I think going, for the next 6 months, that stock is ideally positioned to perform well. So QBE is one I'd buy now. In the emerging company space, so this is actually a stock we own in the portfolio, in your portfolio, Capital Health, CAJ. We had the guys, management in just about an hour ago. They had a trading update at their AGM yesterday. This is a stock that's been sold down. We actually bought this around 40 cents. It's trading around 36 cents at the moment. It got down to 31 in the last month or so. So that, from a valuation standpoint, I think that's a buy here. And I'm trying to think of the last one that I'll go out there and stick my hat onto, but I'm going to choose Audinate 88, which is another stock we've bought recently in the audio space. They've been sold down basically on the back of supply chain issues, but what we're seeing out of the competitors and the other businesses that operate in that similar segment is really strong demand growth. It's just delivering the products and the services that they are selling as the important thing, or the challenging thing at the moment, given supply chain disruptions. We view that as a short-term issue. So that stock has been sold down on the back of those issues. So that would be a buy as well. I'd chuck in a couple more as well. So the Trade Desk is one that's ripping to all-time highs. We hold it, but that momentum in that stock is really high. And another one in the large cap space I'd be happy to buy here is ResMed. I know it's a little bit boring and everyone talks about it, but we've bought it recently into weakness, and we think that one's a buy as well. So you asked for three, you got five, Harry. There you go. That's what you get at Market Matters. You get under promise, over deliver, as we say.
Good stuff. Good to hear a couple of emerging companies' portfolios. You got some faith in that portfolio.
It's been our best performing portfolio over the last little while, so we've got to back that. You're doing well in there, mate.
Got the lights out. All right, good stuff. Thanks, James.